What is going on today, YouTube? Today we're going to talk about whether the stock market's in a bubble, it's ready to pop, and what to do for the years ahead for your investments, your investment advice, and how to protect your hard-earned money and wealth. So to get right into it, I'm going to talk about a couple things Charlie Munger just came out with, a couple things on the Forbes website that came out with, and just a couple things that are driving this crazy market right now. So I'm sure you know, like stock market, post-pandemic and everything, took a big dip back in March of 2020. Huge dip. No one ever saw it coming. It was one of those black swan events and just crashed the entire thing. Now all of a sudden, it's gone up to where we were pre-pandemic and then way above that, as you can see in this chart here. So there's a lot of things driving this. I mean, it's one thing. There's a bunch of stimulus going in the market. There's a bunch of loans going out. Money's very easy to get. There's a lot of credit out there. A lot of companies and stuff are just buying back their shares because there's cheap debt. And when this happens, I mean, companies, they think they're helping out the everyday person or investor. Hey, they're investing in our company. We can't really do anything with this extra cash we have on hand because of our limiting capabilities to raise our values or revenue right now. So we're just going to buy back our own shares, increase the price, and that's our way of paying back investors. A lot of companies will do this for even various reasons. They'll say like, "Hey, we think we can do better with your money than we can with paying you dividends. So we're not going to pay you dividends, and we're just going to keep on buying back our shares. We buy back our shares, our stock price goes up. Our stock price goes up, you make more money. You get a better return on your investment." And that's their theory. That's their philosophy. Yeah, works a lot. Works sometimes. Work doesn't. That's where people get mixed feelings about why don't they pay dividends or why do they pay dividends or just anything like that. But that's why. If a company thinks they can do better off with their money than they can just giving it to you, making better returns for you, that's what they're going to do. So that's one reason. Cheap debt means companies are just keeps on buying, and that's just making stocks soar and soar and soar and soar, especially these technology stocks. I mean, and we'll get into our second point here with this, but these technology stocks, everyone's so in on them because they know like everything's shifting online, everything's shifting to away from brick and mortar stores, everything's shifting to those valuations of those companies like Zoom, Microsoft Teams, Skype, Netflix, everything virtual, everything like you can access from home. That's what people are feeling. Hey, that's the best investment out there right now because right now that's what it looks like our future's heading to. There's going to be less actual everyday commuting and more just going out and doing it. Another reason. Now, it is a contributing factor of your everyday investor, me and you. So, kind of like I said in the beginning, people are getting stimulus. This stimulus is going straight into the market. And with these new laws and regulations that make these stock trading platforms with 0% commission fees, it's unreal. Like people were just trading in and out like crazy. So before, I mean, it depends. I don't know how long you've been in the market or whatnot, but there used to always be commission fees. So when you buy or sell, trade a stock, it was anywhere from $5 to $7. Then Robinhood came out, and they were like the pioneer of this. They're like, hey, you know what? No trading fees. Come to our platform, and that was a great way to get people to come to their platform. So people started coming to their platform. They're like, yeah, we can do trades, and it doesn't matter. I can buy and sell in and out in a day. I don't have to waste that $5 or $7. Which in hindsight, I hated. I hated that $5 to $7 fee. I was just like, well, if I'm going to buy something, I better make sure I'm getting a lot of shares of it, and I'm going to hold it for a while. I don't want to go in and out and waste $5 or $10. Or I should say $10 or $14 if I'm going in and out, because I got to pay that commission fee to buy it, and I got to pay that commission fee to sell it. So that's how Robinhood pulled in a bunch of investors and everything. And then other brokerages, of course, wanted to compete with them. So TD Ameritrade, Fidelity, stuff like that. E-Trade back before, Scottrade before they were sold out, bought out. They all started making zero commissions fees as well. So trades are free. You buying and selling, no cost to you anymore. So that brings me to my next point with this. Okay, I said everything's being caused by these everyday investors, right? These new investors, they can't lose money in their eyes. They're buying and selling, and there's a lot of philosophies out there. Hey, I'm gonna like one quote. This was like a TikToker, Redditor said, I see stock going up, I buy it. I buy it, I hold it until it stops going up and starts going down, and then I sell it. And that's not how to play this game. This is good. I mean, it's really going to come back to bite us eventually. It's not, this doesn't work like that. There is no valuation of companies anymore. There's no anything. So these chat rooms, everything else is just pumping up these stocks. And when they're done pumping up these stocks, they sell them. And yeah, like I said in my previous video, first one in, first one out, you make all the money. Last one in, last one out, you lose all your money. Because buy up here, you sell down here. Last in, last out. First in, first out, you buy down here and sell up here. Yeah, I mean, there are people out there making tons of money, and great for them, good for them. But guess what? This doesn't happen like this all the time. The last time this happened, good scenario, was dot-com bubble. Dot-com bubble, all these amateur, I'll call them retail investors, were going in, they just saw these tech stocks, and they were like, you just buy them, they go up and up and up and up and up and up. And yeah, that happened for a while, and that was a big thing. 2000s, 2002, so like anywhere in that range. And then all of a sudden, the stock market crashed, and people couldn't do this anymore. So it weeded them out. And then, it took years. It took about 20 years now before people to feel comfortable in doing this again. It's funny how quickly we forget about what happened previously. Another famous quote, Buffett, Charlie Munger, all them great investors use all the time. Be fearful when others are greedy, and greedy when others are fearful. Right now, everyone's greedy. They all want in and out quick. Quick buck, in and out, done, and move on. Move on to the next stock that's being pumped up right now. It's just it's not going to end well. It's really not. And there is so much debt and so much leverage and so much everything into this market right now, and that's why these prices are so high. There was articles back before that said about all of our stimulus money, they noticed like a huge surge in the stock market because people were just getting stimulus checks and putting it straight in the market. Yeah, there's people out there that use those stimulus checks for what they're intended for, but so many people just took these checks and put them straight into the stock market because we've been taught over and over and over by these professionals, buy the dip, buy the dip, buy the dip. All you hear, all you see, and you know what? March, everyone's getting the stimulus, and everyone's seeing buy the dip, buy the dip, buy the dip. And guess what? Everyone won because it was down here, and now it's up to beyond highs before pre-pandemic. And just my opinion, we are not at a level, economically wise, across the world, across the U.S., across everywhere, that can justify these prices being higher than they were pre-COVID. We're not there. Pre-pandemic, we are not there in my eyes. Stuff is not back to normal. Stuff is not functioning like normal. People are not traveling. People are not eating out. People aren't doing everything. Yeah, your town or little place may be different, but across the vast majority, it's nowhere close to where it was. Nowhere close. Those are things you need to think about. Like, how can our economy be worse overall than it used to be? And now our stock market's trading even higher. Yeah, it's being driven by these tech companies. Great. But are the tech companies really worth as much, or is it just from people jumping into Apple, jumping into Facebook, jumping into Amazon, anything they can get their hands on? Another thing Charlie Munger said, investors get lured in by a bubble. That's exactly what's happening right now. Everyone's looking back, March lows, and they're thinking, wow, if I bought back in March, I pretty much would have doubled my money if I bought anything. So now everyone's like, it's FOMO. It's coming out FOMO again. They're being like,
I don't want to miss out on these gains. Everyone had such high gains, so I'm just going to pour all my money in. And
that's usually what happens. You have a dip, it goes up, and then people are like, oh my God, it's back up to where it was or past where it was. I got to get in now because it's going to keep on going up forever. And yes, eventually, I'm not saying it's not going to keep on going up forever. So let me retract a little bit. Stock market over time does go up to the right, right? It goes up to the right over time. On average, it's going to go up anywhere from 7 to 12% per year. On average. I mean, average after, if you're just in the like normal S&P 500, on average, it goes up 7% a year. I'm not saying that's going to change. That's going to hold true forever. The thing is, you need to make sure you're diversified. So if something like March happens again, how did you feel in March? If you were thinking,
Oh my god, the world's ending, I need to sell all my stocks, I need to never buy stocks again.
then you need to look at your portfolio right now and remember those feelings back in March. Because think about this. If you were panicking, how did you feel? Did you like that? You probably didn't like that feeling. The point of investing for the long term is to know what you're investing in and have it set in stone so you don't have to panic. You know the market is going to go up and down. It's going to fluctuate, but over time it goes up and to the right. And you got to realize this, and you got to be comfortable with where you're at. You got to be comfortable with seeing, 30% losses. That's a ton, but you got to be comfortable with seeing that, knowing that hey, I'm diversified enough. I'm in the right investments that over time my investments are going to make me money. Don't worry about the day-to-day fluctuations. Don't worry about the month-to-month. Don't worry about the year-to-year. Now, if we're going on a 5 or 10 year span of not going anywhere or just like losing value, then yeah, you got to rethink like what you're doing. Maybe you're not invested in the right stocks. Maybe you're not invested in the right mutual funds. Maybe you're not invested in the right equities, bonds, treasuries, all that stuff. Be diversified enough so you are comfortable with seeing these fluctuations, knowing that over time you're in the right investments to get yourself where you want to be when you want to use that money. Overall summary of this video: be diversified, know what you're investing in, know the market is going to go up and down, and know the market is not just going to go up. You can't just buy these stocks till they go up and sell them when they start going down. That is just not how this market's supposed to work. And you know what? I'd be very interested to know. Let me know how you're diversified in the comments below. So I hope you liked the video. I'll see you in the next one.